This is the daily fiscal pulse for the 22nd of July, 2026. We're doing what we always do here, taking a single day look back to show you how the money flow settled through Wednesday's close. Before we dig into the actual flow data, let's acknowledge what's capturing market attention right now. AI and technology stories are front and center. You're seeing coverage like Intel posting an 11% stock gain as the chipmaker benefits from the AI boom and posts its fastest revenue growth in nearly 15 years. That narrative is clearly shaping how traders are positioning. Given that backdrop, it's worth looking at what the fiscal flows are actually telling us. The headline number on transfers is $39.6 billion for the day. Standing alone, that's neither weak nor strong. What matters more is the directional shift. The 5-day rolling average has dropped to roughly half of what we've been observing in recent weeks. The driver here is household transfers, which accounted for $32.4 billion of that total. The ES chart reflects the same pattern. ES futures settled at 7,536, sitting below the 20-day moving average, which is at 7,539. The broader 20-day band spans 267 points and is drifting downward. So the flow data and price action are aligned in sending the same signal. Zoom out and the deceleration becomes unmistakable. Government spending on a 5-day basis is averaging $7.2 billion daily now. Stack that against the 20-day average of $15.1 billion and you've got a meaningful pullback. What this translates to in practical terms is less liquidity entering the system, less capital flowing through household accounts and into equity markets. The result is tighter financial conditions overall. Year over year the story doesn't change much. Spending sits at roughly $1,338.7 billion with no material shift in fiscal support coming into view. For anyone considering long exposure, the fiscal backdrop is worth considering seriously. We're looking at conditions that aren't really providing support. Our gauge is sitting at -76 right now. Historical precedent does offer some perspective though. We've encountered similar setups repeatedly, and even with lighter liquidity flows, the S&P has averaged around plus 1.5% over the subsequent month. Liquidity and market direction don't move in lockstep. Markets have a way of grinding higher regardless. The positioning picture adds nuance. Leveraged funds keep adding long positions while margin debt is at the 100th percentile. That's stretched. When we look at history, readings that extreme tend to flash caution more than confidence. This is where the pieces fit together. Fiscal flows are running below year-ago levels, which means the shock absorber in the system is weaker. Supportive headlines can still push markets higher, but when volatility events occur, like turbulence in AI or tech, the drawdown can be sharper because there's simply less liquidity beneath the surface to cushion the move. We're also tracking 2 straight days of climbing fiscal transfers. Our historical work shows that pattern has tended to lead to near-term ES strength. It's not definitive, but it's something we monitor. 2 calendar items warrant attention. Month-end settlement hits on the 31st of July and typically alters near-term flow patterns. Then around the 15th of August, the Treasury coupon interest payment window opens up. Clearly fiscal headwinds are visible in the numbers. What we may be seeing is that tightening pace starting to plateau. The next meaningful move probably hinges on how these upcoming flows actually land. That's where we stand today.